I want to start by being completely honest about where we are right now. We're at a point really just 2 days away from a financial tipping point that's going to affect millions of seniors, soon to be seniors, people who thought they were perfectly safe. And yes, I know that sounds dramatic, but it's true. It's the sort of situation I've been observing my entire career. I've watched markets rise, I've watched them fall, I've seen policy shifts, demographic changes, and frankly, ordinary people lose their life savings when they weren't paying attention to the signals. Tonight, I'm going to walk you through it, step by step, and by the end, you'll understand precisely what to do to protect yourself and your legacy. Now, here's a bold claim, maybe even uncomfortable. Most of what financial advisors have been telling people for decades is wrong. Not maliciously, mind you, they mean well, but if you don't act in the next 48 hours, it could cost you dearly. Everything you've worked for, everything you've saved could be at risk. And I promise this is coming from decades of observation, not speculation. I've studied these exact scenarios for over 50 years. So tonight, I want you to listen carefully and not just absorb the numbers, absorb the reasoning, the psychology, and the strategy behind them. Let me start with the problem most people face. You've saved diligently. You've diversified. You hold for the long term. You've trusted Social Security and Medicare, believed your bonds are safe, your portfolio conservative. You've done everything right, or so you think. Underneath, though, is hidden risk. Inflation that erodes purchasing power, interest rate shifts that decimate bond values, sudden policy changes, market jolts, and the kind of systemic pressures most people never anticipate. You may feel safe, but oftentimes that's an illusion. Let me give you a little history. In the 1970s, inflation exploded. Bonds, which people thought were conservative, lost value in real terms. The early 1980s, interest rates spiked and defensive investments, those supposed safe havens, didn't hold. People thought they had security, but they were caught flat-footed. And here we are today, facing a convergence of risks unlike anything I've seen before: demographic shifting, central banks juggling inflation and growth, enormous government debts, markets tightly correlated. Ask yourself honestly, are you prepared if inflation hits 5 to 7%, interest rates rise, and markets wobble all at once? Here's what most people don't realize: the conventional wisdom about diversification and long-term holding can fail when conditions shift in unexpected ways. Bonds go bad, cash loses value, stocks fall together. Safety, it turns out, is relative. I'm not exaggerating. I've tracked decades of data, policy shifts, and personal stories where defensive portfolios became traps. Let's start with the illusion of safety. Most retirement portfolios rely on static assumptions: bonds, CDs, a chunk of stocks, cash. But these assets are not immune to real-world shocks. Inflation erodes cash, rising rates punish bonds, policy changes shift the playing field overnight, liquidity dries up, and correlations tighten, meaning everything falls together. Even your most conservative investments can collapse if the environment changes quickly. I want to share a story. A few years ago, I met Margaret, a retiree who had done everything right: 60% bonds, 30% stocks, 10% cash. She thought she was safe. Then a sudden spike in interest rates hit. Inflation rose unexpectedly and her bond ladder collapsed. Cash lost purchasing power. Her stocks went underwater. Meanwhile, another investor, let's call him Robert, had allocated a small portion, 10% of his portfolio, to adaptive buffers, strategies designed to absorb shocks. When the crisis hit, Robert could reposition, buy selectively, and his net worth grew even as Margaret's declined by 15–20%. That difference, preparation and a plan built for stress, not comfort. Now, let me break down exactly what happened with Margaret and Robert because there's a lot to learn here. Margaret's portfolio looked safe on paper: 60% bonds, 30% equities, 10% cash. It's exactly what most advisors would call conservative. But here's the problem: she didn't consider the environment she was about to face. Interest rates had been historically low for years, inflation was creeping higher, and the bond market was sensitive to both. Margaret's bond ladder, her supposed defensive cushion, was made up mostly of long-term fixed-rate bonds. When rates spiked suddenly, the value of those bonds dropped sharply. She saw her net worth shrink before her eyes. Now, you might ask, but Warren, she had cash too, right? Sure, 10% in cash. But cash isn't immune to inflation. That money buys less and less over time. Margaret thought she was safe, but safety on paper isn't the same as safety in practice. Her equities didn't save her either. They were diversified across sectors, but in this particular shock, the correlation between her stocks increased. Everything fell together. So even what she thought was balanced didn't provide the cushion she expected. Meanwhile, Robert had something Margaret didn't: adaptive buffers. Now, let me explain what I mean by that, because people often misunderstand. Adaptive buffers aren't magic. They're small allocations in your portfolio that are designed specifically to respond when markets are stressed. They might lag during calm periods, yes, but they provide protection when things go sideways. For Robert, that meant about 10% of his portfolio was in a combination of tail risk hedges, volatility-sensitive instruments, and short-duration flexible allocations. These positions are like shock absorbers. They don't make money all the time, but when the market shakes, they absorb impact and create optionality. When the interest rate spike hit, Robert didn't panic. He knew the structure of his portfolio. He understood which positions were vulnerable and which were adaptive. His fixed income was partly short duration and floating rate, so the shock didn't wipe it out. His adaptive buffers kicked in. They gained value as volatility spiked, and because he had liquidity set aside, he could reposition. He bought selectively into equities that were beaten down but fundamentally strong. Within months, Robert's net worth not only held up, it grew. Margaret, on the other hand, was left watching her nest egg shrink and was paralyzed by uncertainty. Let me tell you, the lesson here isn't just about instruments or hedges, it's about mindset. Most people think if I just do what's conventional, hold bonds, hold stocks, diversify, I'll be safe. That's like driving a car blindfolded because you trust the brakes. It works until conditions change suddenly. You need to anticipate, plan, and structure your portfolio to respond, not just survive, but to take advantage of shocks when they happen. Now, you may wonder what exactly constitutes an adaptive buffer. Let me give you specifics so you can see how this works in practice. First, think of long-dated put options on broad indices or bond futures. These are insurance-like instruments. They cost something to maintain, but when the market drops sharply, they pay off handsomely. Then there's volatility-sensitive strategies. For example, certain VIX-linked positions or structured funds that increase in value when market fear rises. You may have heard me joke, I like cash because it's dry powder, and this is exactly what these strategies are: dry powder that grows in value when fear spikes. Next, we can look at convertible securities with embedded optionality. These instruments allow you to participate in upside if volatility or market swings favor you, but also provide a buffer on the downside through their fixed income component. Then there are relative value hedges or market-neutral strategies which might look boring in calm markets, but when correlations converge and traditional assets move together, they perform as intended. Even small allocations to uncorrelated real assets like certain commodities or alternative investments can be part of the buffer, giving you that extra layer of protection. But here's the key, it's not about going all in on these strategies. You don't want to overweight, because during calm markets they can drag performance. Think of it as insurance. You're paying a small premium for the peace of mind that comes when storms hit. Robert's allocation, roughly 10%, was enough to protect him and give optionality without dominating his portfolio. It's about balance. Now, the other critical factor Margaret missed was liquidity. When shocks happen, having your capital locked in illiquid funds is a trap. You can't act, you can't reposition, and your losses are magnified. Robert kept a portion of his portfolio in highly liquid instruments, short-term treasuries, floating rate notes, money market funds, so he could deploy capital at the right time. That's how he was able to take advantage of market dislocations while others were forced to sell at a loss. And let's talk about psychology for a moment. Most losses don't come from the market, they come from fear and hesitation. Margaret froze. She panicked. She didn't act because she didn't have a plan. Robert had a plan, and his calm allowed him to act decisively. I often say, be fearful when others are greedy, and greedy when others are fearful. It's not just a catchy phrase, it's a principle for navigating moments exactly like this. Opportunity hides beneath fear, but only if you're prepared. Now that we understand the difference between Margaret and Robert, let's talk about what you can actually do to structure your portfolio like Robert's. I call this the 60-30-10 framework, short, simple, and effective. And yes, I use something similar at Berkshire, not because I love tinkering, but because it gives you optionality and power in uncertain times. 60% of your portfolio should be in short duration, highly liquid instruments. I know, not very glamorous, right? But glamour doesn't keep your money safe. Treasury bills, short-term government bonds, floating rate notes, and high-grade money market funds, these are your bedrock. Why short duration? Because when interest rates spike, long-term bonds collapse. Short-term instruments reset quickly, keeping you nimble. Liquidity is just as important. If everything else is moving fast and your money is locked up, you're stuck. Think of it as having dry powder ready for opportunity. You can move while others are scrambling. 30% goes into what I call adaptive strategies, positions that bend when stress hits. Convertible bonds, volatility-sensitive funds, hedged equities, even certain arbitrage or risk parity allocations. These don't always outperform in calm markets, but they're designed to react differently than the rest of the portfolio. They protect when correlations converge and traditional assets move together. This is where you start to see the magic of adaptive buffers. A small allocation, thoughtfully placed, can make a big difference when the storm hits. The final 10% is your asymmetric hedge or volatility exposure. Think long-dated puts, volatility ETFs, or tail risk hedges. These are your offensive defense. They cost a little in quiet markets, but when fear spikes, they grow rapidly. The key is not to over-allocate. 5 to 15% is usually enough, but this small slice is what turns a defensive portfolio into a portfolio that can actually gain when chaos strikes. Now, let's talk about timing, because even the best allocation is worthless if you miss the window. In the story I told earlier, Robert didn't just have the right structure, he knew when to act. And here's what you should watch: sudden yield jumps in key bond ranges, liquidity drying up, spikes and correlations across asset classes, and widening bid-ask spreads. When you see these signals, it's time to deploy your adaptive strategies. Not before, not after. Timing matters. Let's go back to Robert and Margaret for a moment. Their difference wasn't luck. It wasn't insider information. It was preparation, structure, and discipline. When the market moved, Robert had a clear, actionable plan. He didn't guess. He executed according to rules he had established in advance. That's what you want: a repeatable process, not a hope. And here's the part most people overlook: crisis is opportunity. Every major disruption in markets has created generational wealth for those prepared. The 1970s inflation destroyed paper savings, but those who bought quality equities in the 1980s became millionaires. The dot-com crash, 2008 financial crisis, they all created opportunities for disciplined investors. This upcoming reset, the spike in rates, bond revaluations, liquidity shifts, could be your version of that. But only if you act, only if you prepare, only if you structure your portfolio correctly. Finally, let's tie it all together. Audit everything you own. Know the duration, liquidity, and vulnerability of every position. Trim and hedge exposures that are dangerous in the current environment. Increase your liquidity. Allocate adaptively. 25 to 35% of your portfolio to assets that flex under stress. Maintain 5 to 15% in asymmetric hedges, options, or volatility-linked instruments. Set triggers. Decide in advance when and how you will act. And above all, stay in the game. If you panic and exit permanently, you can't recover. Preparation is your antidote to panic. Remember, 2 days can make all the difference. 2 days to review, rebalance, and prepare. 2 days to decide if you'll be Margaret, watching value evaporate, or Robert, calmly navigating chaos. That's the choice in front of you. And when the market resets, when volatility spikes, when institutions scramble, your preparation will allow you not only to survive, but to thrive. So protect principal, maintain liquidity, think decades, not days, review and adapt, and above all, stay rational. Markets will do what markets do, but you, if prepared, will act with clarity and composure. That's how wealth is preserved and built. That's how crises turn into opportunities.